Ladies and gentlemen, good day and welcome to V2 Retail Ltd Q2 and H1FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. The presentation which V2 Retail Ltd has uploaded on the stock exchange and their website, including the discussions during this call, contains or may contain forward-looking statements concerning V2 Retail Ltd business prospects and profitability, which are subject to several risks and uncertainties, and the actual result could materially differ from those in such forward-looking statements. I now hand the conference over to Mr. Akash Agarwal, Whole-Time Director, V2 Retail. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. A very warm welcome to our Q2 and first 6 months earnings conference call. I hope everyone has had an opportunity to look at our results. The presentation and press release have been uploaded on the stock exchange and our company's website. Building on the momentum of a record FY24 performance, we are pleased to report a strong first half performance in FY25. Our outstanding results underscore the effectiveness of our strategic initiatives. The performance demonstrates our commitment to sustainable growth, customer delight, and operational excellence. We are confident in our ability to maintain this trajectory, driving continued success and value creation for our stakeholders. Our team of designers, merchandisers, and inventory managers drives our competitive advantage, distinguishing us from the competition. Their specialized knowledge enables us to design on-trend products that captivate customers, curate assortments that anticipate market shifts, and optimize inventory for efficiency and sustainability. This expertise fuels our ability to stay ahead of fashion trends, meet customer needs with precision, and minimize waste and maximize value. Our team's expertise is the backbone of our success, empowering us to deliver exceptional products, experiences, and value to our customers. Let me start with some key updates. We are thrilled to start the current financial year with record half-yearly sales during the first half of FY25 and a 2,551% increase in year-on-year PAT. The company added 22 net stores during the first half of the year, taking our total store count to 139 stores. We have added another 5 stores during the current quarter, taking the current store count to 144 stores. The store addition momentum will continue as we have a very healthy pipeline of upcoming stores. We have seen robust demand in ongoing festive season, and we are very hopeful that ensuing wedding season and the winter season will further strengthen our position in the areas we operate. The growth across all our stores has been encouraging, translating into a robust SSSG of 36% in the first 6 months of this year. We have been able to consistently deliver high double-digit SSSG for the last few quarters due to our customer-centric and product-first approach. The volume growth has been 49% in the first 6 months of the year. The full price sales contributed 91% in the first 6 months of the year, compared to 85% in the last year for 6 months. We believe that our sustainable and scalable business model would help us to improve our ROCE and ROE going forward. Now I would highlight some performance highlights for the first half of this year. Revenue from operations stood at 795 crores, registering a growth of 61% on year-on-year basis. Gross margin stood at 28.2% compared to 29.4% last year. EBITDA for the quarter stood at 88.5 crores as compared to 55 crores in the same 6-month period last year, registering a growth of 60%. EBITDA margin stood at 11.1% as compared to 11.2% last year. PAT stood at 14.4 crores as compared to 50 lakhs in the corresponding period last year. Now, performance highlights for the quarter. Revenue for the quarter stood at 380 crores, registering a growth of 64% on a year-on-year basis. Gross margin stood at 27.3% as compared to 28.1% in the corresponding quarter last year. EBITDA for the quarter stood at 33.1 crores as compared to 19.9 crores last year, registering a growth of 60%. EBITDA margin stood at 8.7% as compared to 8.6% in the corresponding quarter last year. With this, now I leave the floor open for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from Abhishek from ABC Capital. Please go ahead.
Hello, am I audible?
Yes, you are.
Yeah. Just wanted to know what was the cause for the loss in this quarter? Like, was it a conscious decision in order to get higher volume? And will it happen in future going forward?
So it is historically a cyclical business. So historically, Q1 and Q3 are our strong quarters. But I think because our base has increased now, all 4 quarters are EBITDA positive, which was never the case. So we will continue to deliver EBITDA positive in all 4 quarters. But if you talk about PAT numbers, yes, it's a cyclical business where the festive season is during Q3. So that's usually our best quarter. Then it's followed by Q1. And Q2 is a bit muted. And then it's Q4.
Okay. And the investor presentation showed that 2 stores were closed. What was the cause?
So one store was not profitable. So we always take into contingency that if we open 100 stores, we might have to shut down 4-5 stores. And one store we had to relocate because we found a better a better floor plate and a better location in the same city.
Okay. Thank you.
Thank you. The next question comes from Palash Kawale from Nuvama Wealth. Please go ahead.
Thank you for the opportunity and congratulations on the good set of results. My first question is on employee cost. So our employee cost was slightly elevated in the quarter. So if I look at the historical trends from Q1 to Q2, there's not much difference in employee cost, but this time they were slightly elevated. So any reason, any particular reason, or just store additions?
So we are planning to open another 20 stores in the 3rd quarter. So what happens is there's a lot of recruitment that happens prior to the stores being opened. For example, there are 10 store managers already getting training in a lot of our old stores. So there will be a slight increase in cost because of the new store opening.
Okay, got it. So what is the total number of stores that you plan to open in H2, sir?
It should be around 40 stores.
Okay. And sir, if I look at the size of the opportunity or potential number of towns or cities in the country, how do you see that long-term opportunity, or what is that particular deciding factor that you take into consideration if you want to enter a new town?
I think it's too early to have that conversation because unless we reach 3,000-4,000 stores, there is enough potential, because we look at any constituency that has a population of more than 5 lakh, and there are a lot of tier 1 and tier 2 towns where we can have multiple stores. For example, now in Bhubaneswar we have 5 stores, in Patna we have 6 stores. So there is a lot of scope still left. So I think that conversation is once we reach thousands of stores.
Okay, sir. That's it from my side, and happy Diwali to you.
Thank you. The next question is from Yash from Stallion Asset. Please go ahead.
Hi, thank you for the opportunity, and congratulations again on a good set of numbers. So I just want to understand how has the festive season been like? We've already been about 3 weeks through October. How are you assessing the demand right now?
So I would say even in the first half of the year, because we had such a good SSSG last year of 31%, we had projected only 15% SSSG, but we performed very well and we exceeded our own expectation and we got a 34% and we've seen that momentum carry on to October as well. And but a lot depends on November and December and the winter and the wedding season. But I would say we are still doing high double-digit SSSG, and we have seen the footfalls also increase quite a bit. So it's been better than what we predicted.
Okay, that's good. And so, as you said that October, I mean, your third quarter typically is the strongest quarter for the company. And, if I look at December 23 quarter, you had grown by almost 62% quarter on quarter. Before that, December 22 quarter, you had grown about 25% quarter on quarter. So do you think then, this quarter as well, we could see, I'm not talking about exact numbers, but I'm just saying that directionally you would see, 25, 30, 40% and something along those lines, like a very big jump or a quarter on quarter basis?
If you talk about, yes, total revenues, yeah, the revenue growth should be more than 35%.
Okay, on a quarter on quarter basis, you're saying, right? Okay,
Yeah.
Okay, thank you very much and all the best.
Thank you.
Thank you. The next question is from Ankush Agarwal from Surge Capital. Please go ahead.
Yeah, hi sir. Thank you for taking my question. So the first question is around profitability. So how do you see profitability going into third quarter and for the full year, given that gross margin is something that we have seen consistently reduce a percentage or so every quarter? And I do understand that reducing gross profit margin, but having higher operating leverage in the EBITDA margin is doable. But at what point do you believe this gross margin will stabilize and at what level, if you can highlight?
So we've always mentioned that instead of focusing on gross margin percentage, we always focus on EBITDA percentage. So if you look at the first 6 months, last year our EBITDA pre-Ind AS was 16.7 crores, and this year it's 40 crores, which is almost a 140% jump. So I think if you look at EBITDA, we have been exceptional, and going forward, we always guide that we want to reach 10% pre-Ind AS EBITDA levels in the next 2 to 3 years.
10% pre-Ind AS in next 2 to 3 years. Any idea on how much you will be able to reach this year, FY25?
So this year our EBITDA guidance is about 120 crores pre-Ind AS.
Okay. The second question is around store addition. So for last 2-3 quarters, we have consistently seen you exceeding your store guidance. Now this quarter, you're saying that you're going to add another 40 stores in H2. So you would be exceeding your earlier guidance of 50 stores in FY25. So I wanted to understand at what point of time do you think that you will, curtail the store expansion, because beyond a certain point, aggressive store expansion will obviously put constraint on operating leverage, your cash flow, and working capital requirements. And over time, the SSG itself is going to taper off from the current high level. So that itself would not allow a lot of operating leverage on existing stores to put more new stores. So at what point do you think you will, curtail this aggression? Because given the guidance of H2, you will probably close FY25 with around 50% store growth.
Yes, but if you look at the last 4 years, it was a period of consolidation and there wasn't much growth and we did not add a lot of stores. We were focusing on strengthening our model. We were focusing on strengthening our product. And now we see the results of the hard work that we put in the last 4 years. So now we feel like if we get an ROE of around 20%, then we can easily open 50-60 stores in a year. So I don't think it's a very ambitious number, and that is why, like, if we get a good location and even the new stores, the base is much higher now. So 2 years back, the new stores used to do 600 rupees per square feet per month. But now even the new stores have a base of 900 rupees per square feet per month. So we don't want to keep money in the bank when we have the management bandwidth and the merchandising bandwidth to be able to open 50-60 new stores with internal accruals. because we are not leveraging our business in order to open these stores. So I think it's a very realistic and a target that we can easily achieve without compromising on business metrics.
Got it. That was helpful. Thank you.
Thank you.
Thank you. The next question is from Varun Singh from AAA PMS. Please go ahead.
Am I audible?
So there is a lot of echo. If you're using the speakerphone, may we request you use the handset, please?
Yeah. Sure. Thank you for the opportunity. So my first question is on the productivity improvement. Revenue per square feet number is quite good for us right now. But on this front, like, what is the how do you look at, how much scope is left for improving this number further from the current level of maybe 900,000 rupees? That's my first question.
So if you talk about scope, we have, like, I think more than 20 stores that do more than 1,400 rupees per square feet of sale also. So I think the day we feel that each and every option or the whole assortment in our store is best in class, best in the world, that day we'll be able to tell you, okay, this is the potential that the maximum per square feet sale that a store can do. But I don't think we will ever reach a day where we feel, okay, we can't do anything better in our assortment. So like I said, even with a 31% SSSG last year, we are showing a 34% SSSG this year. So there are a lot of stores that are already doing 1,400 rupees per square feet. They are also growing at 20-25%. So I don't think there's a cap to this number. But yes, our first target was to reach 1,000 rupees per square feet of sale, which we'll do. I think we'll exceed that this year. And our next immediate target would be 1,200 rupees per square feet of sale per month. But if you talk about potential, I think if your product is world class and if you sell products at the margin that we sell, which is best in the industry, it's only a 55% markup and we are selling 91% of our products at full price, then I think the sky's the limit. There's immense potential.
Understood. All right. So, I mean, on 1,400 rupees, 25% SSG, if we are able to do it, so then like 1,750 is the number, and if we do into 12, so that 20-odd thousand rupees per square feet annual, that number is quite, that's quite good, right? Understood, sir. And secondly, on the product development front, like what are the key markers for us with regards to what are we doing currently to keep the team at the best in class? If you can maybe want to highlight anything on that front.
Yeah, so see, every product has 4 main attributes. It's the design, the fabric, the color, the fit. So, it's getting all 4 correct. So even if you get 3 of those right and 1 wrong, then the product doesn't sell. So in terms of product development, it's all about research. It's all about, who your inspiration brands are, what kind of fashion are you following, what kind of brand identity you are trying to create. So, it's very hard to put into simple words, but there are n number of processes that the team has to go through, whether it's using some, paid tools in order to get what color forecast is there for the next season, what kind of fits are going to sell in the next season, what kind of new fabrics are going to sell in the next season. So I think it's a mixture of, using data, leveraging data in order to see historical trends as well as forecasting future trends and creating assortment with the best blend of both of that.
Yeah, got it. So that's about the product development and about the team.
So, we have almost a 40 to 50 member team, and all the crucial people have been given retention bonuses, and they are all linked to the profitability of the company. They all have incentives also that is linked to their targets. So I think it's a healthy situation to be in.
Right. No, actually, what I meant was maybe how many foreign trips, etc., that the team would be doing, or what are the activities that they are doing to, which is leading to this fantastic revenue per square feet numbers, etc. So I just wanted to maybe.
I don't know the exact number of trips, but yeah, the team travels to.
Not exact. I mean, but anything on that front.
Yeah, definitely. So there's both international and national brands that we follow, and there's a lot of international, I would say, sourcing in terms of accessories and fabrics, which is very important to create the latest fashion. So when I say research, it has to be done internationally and domestic both. And all the division heads, they travel, they see what's going on, what's the new trend, and that's how we design our new season.
And so just one last question, if I may. In any of our locations, is there a Zudio store nearby? And if yes, I mean, how has been the performance of that of the store in that location? That's my last question, sir.
Yeah, I think we share almost 20 stores where a Zudio is within a 3-4 kilometer radius next to our store, but we haven't seen any sort of significant impact due to Zudio opening because, our ASP is 260-270 rupees, whereas Zudio's ASP exceeds 500. So I think the customer class is different. There might be an overlap, but it's very small overlap. And India is a big market where, more than 80% is still unorganized retail. So it can easily accommodate 4-5 big national level players. But of course, it's of course depends on who's executing their plans well and what kind of a niche are you targeting and where do you position your brand?
Absolutely. And sir, for these 20 stores, our revenue per square feet would be more than 1,000 rupees per month.
I would have to take out the average, but now the company average is more than 1,000. So yes, I think it will be more than 1,000. Yes.
All right, sir. That's it from my side. Thank you very much, and wish you a very happy Diwali.
Thank you.
Thank you. The next question is from Chintan Shah from JM Financial Family Office. Please go ahead.
Hi, thank you so much for the opportunity. So I just had one question. So if you see right now the scenario, I mean, everybody is looking to add capacities or add stores, and within our segment or slightly or even in the premium segment. So just wanted to understand, I mean, this is not from a next 3 to 4 quarter perspective, but slightly medium term. What's giving us the confidence that, considering the end customer we cater to, which is sensitive to, say, macroeconomic as well as other factors. So what's giving us the confidence that, we add such stores and beyond 3-4 quarters as well, basically such demand trend will continue. And, we won't see a situation of something like that happened in FY 18-19. When we started adding stores and gradually things per store, etc., numbers declining, and then something or other that hits us and then we get impacted. So this time just want to understand what is giving us the confidence that we won't face a similar situation across the industry and for us as well. Thank you.
So the biggest change I would say is the business model itself. And we completely reinvented ourselves. So in FY 18-19, we were essentially doing a commodity business where there was no product differentiation, there was no competitive advantage. You could find the same designs or similar products in other stores. So there was no brand identity. So now, the work that we put in the last 4 years, now it's a completely different business model. So it's a product first approach. And if you talk about value fashion, and fast fashion, it's a global phenomenon for the last 10 years. If you look at brands like Shein, if you look at brands like Pretty Little Liars, Primark. So this is a segment which is not cyclical as a sector. There will always be value conscious customers, and in India, the middle class is booming. So there would never be I think there would never be a time where, we would not have a customer base. The customers that we're targeting is anyone who earns between 10,000 rupees a month to almost 70,000-80,000 rupees a month. So that covers almost 80% of India. So if you talk about the business model, then like this, because the Gen Zs have a very different shopping habit, where they're looking for affordability, and the frequency of purchases have also increased. So it plays into our strength, and the confidence comes from the fact that we've been able to increase our per square feet sale from, I think it was 680 2 years back, and now this year we'll do more than 1,000. So it shows that the acceptability of the product is there, and the customer is actually seeing the value that they're getting, and they know that the kind of quality that they're getting in V2, it's an unmatched price. So everybody understands value, and especially India, we're all there are a lot of value conscious customers. So that's what gives us confidence that it's the result, and it's the footfall growth, it's the revenue growth, it's the profit growth. And the best thing about this business is, the same bandwidth can handle 100 more stores, because you essentially have to just plan the same number of options. So we want to leverage our existing team, the foundation that we have laid, and that's why we want to expand now, because the last 4 years were a period of consolidation, and it was a period of reinventing ourselves. It was a period of working on increasing our per square feet sales and working on the product, and we feel we've been able to do a good job in that, and that is why we feel now we want to increase our footprint.
Got it. Understood. That's a fair point. Just one follow-up on that. So if we see all the other organized players also, what even they are trying to do is, getting more into private label sales. That is what they're trying to achieve. So my biggest concern is, as they increase their store throughput over, say, increase the store count over next 2 years, basically, then does that value proposition or the increased competitive intensity could hamper our SSSG growth? And as we put more stores, actually the numbers that we're looking at, probably that could be lower, and that could impact our overall financials.
So it's not about who does private labels or who does product development. Even if you look at the best brands in the world, like if you compare Zara to any other brand, it's not like Zara has a different process. Everybody does product development, but it's how you do it, and at the end of the day, it's the assortment that you put in your store. So we feel, and the numbers say that the assortment that we have is much superior to our peers. So it's not that anyone who increases their private label contribution or product development is going to get an SSSG or is going to grow their throughput, because it depends how you're executing it. Because like I said, even a brand who does 1,200 rupees per square feet of sale does the same process, and a brand who does 700 rupees per square feet of sale does the same process. So the secret sauce is not the process, but the result of the output or the assortment that you get out of it.
Got it. Understood. And just one last question from my side, that is on margins. So right now in this quarter, when we had such a strong SSSG growth, plus ASPs have increased, plus discounted sales has been lower, such a quarter where margins have actually been flat. Now, from a next couple of years perspective, when you're adding so many stores, there's obviously going to be costs that are going to come in. And the current existing stores, if I see, the margins have been similar. So while you're guiding for, say, 10% pre-index EBITDA margins, I mean, how do we reach there basically? What will drive this margin expansion?
So most of our costs are fixed costs. So it's a fixed cost business where, variable cost is a very small proportion of total cost. So even if we increase our sales by 10%, you're essentially increasing profitability by 18-19%. So even in the future, we are guiding for an SSSG of 10%. So if you do the math, within 2 years, we'll reach an EBITDA percentage of 10%, pre-Ind AS.
But wouldn't that should be impacted by the cost that will come in from the new stores?
No, the cost would not exceed 200 rupees per square feet per month, even if you're opening new stores.
Okay, fine. All right. Thank you so much for answering the questions.
Thank you.
Thank you. The next question is from Harsh from Nepean Capital. Please go ahead.
Yeah, hi. While all my rest of the questions have been answered, the only question I had was on the store closure going ahead. So with, nearly 9 stores being closed in FY24, and 2 stores, being closed in the current quarter, what is our target store closure for going ahead?
So currently, we don't have any stores that are below the line where we decide to close the store. But like I said, we are opening so many new stores, so there's always a contingency, and we always take that into account that we might have to shut down 2-3% of the stores. So the store closure cost is about 300 rupees per square feet, because most of the fixed assets and other things can be used in the other stores. So it's a part of business, and whenever we open stores, we know there might be a chance that we might have to shut it down. So that's about the closure rate should be about 3 to 4%.
Got it. And if I just may squeeze in one more question, I couldn't really understand the contraction in our gross margin. The ASPs have improved, and as the earlier participant also said that, the discount rates have also gone down. But despite of that, the gross margins have remained slightly lower. So reason for that, that's my last question. Thanks.
We focused a lot on marketing, and our marketing costs is a part of our COGS. That is why it is reflected in the gross margin. So we've been running a lot of schemes and offers for our customers to increase the average bill value and to increase the conversion. And we have seen good results of that. So, and going forward also, like I said, we don't want to target a gross margin percentage number. As long as our absolute EBITDA and EBITDA percentage increases, we don't want to focus on this gross margin percentage. At the end of the day, what matters is if your sales are increasing 20% and your gross margin is decreasing only 5%, so it's still better for our business.
Got it. That's all from my end. Festive greetings to you and your team. Thanks.
Thank you.
Thank you. The next question comes from Yash Sonthalia from Buoyant Capital. Please go ahead.
Hi, thank you for the opportunity and congratulations on the good set of numbers. So my first question is, as earlier participants also mentioned, like we are upgrading our guidance of store opening. So will we be able to open those stores from the internal accrual, or our debt on the balance sheet will increase for the year?
No, it will be through internal accruals, and even that the debt that we have on our books, it's essentially for bill discounting. So our vendors have a facility where they can take payments and they can discount their bills whenever they want. So we have a CC limit from the bank, and we use it because we want to be one of the best paymasters in the industry, and we want to give that facility to our vendors.
Got it. And second question, like everyone was mentioning, the competition in the market is increasing. So many of your peers are opening more and more stores like you. So do you think this will increase your cost of acquisition of customers? Like in this quarter, the advertisement cost increased, due to which the gross margin have declined. So do you think structurally your employee cost or maybe your marketing cost will increase?
No, I don't think it will increase, but rather I would say, as we are opening more stores, we'll be able to leverage our head office and DC costs. So going forward, I think the cost per square feet will come down when we open more stores.
Got it. And we were doing some improvement on the inventory side in our warehousing and stock keeping unit. So where are we on that?
What kind of improvement? Sorry?
So the backup stock we were trying to reduce from, I think, 30 days to 15-20 days with more orders coming on time.
Yeah, so we have been able to increase the on-time delivery from almost 40% to 80% in the last 7-8 months by, educating our vendors, by improving our TNA, by hiring a lot of QCs at the source city. And I think the inventory days, the inventory change that you're talking about, it will start to be in effect from Q4.
Got it. So what what are our expectations or the ballpark number of inventory days for the upcoming years?
So we should be able to reduce it by 10 days from, the last 18 months historical numbers.
Got it. Thanks. That's all from my side. Happy Diwali to the team.
Thank you.
Thank you. The next question is from Tejas Shah from Avendus Spark Institutional Equities. Please go ahead.
Hi. Thanks for the opportunity and congrats on good set of numbers. First question is, when you see the numbers, it is largely that you have kind of countered the overall slowdown. And at the same time, your number also confirms the feedback that we are getting from FMCG companies that there is some uptick at the mass end of the pyramid. So just wanted to know, when you double click on your store, your growth based by tier 2, tier 3 and then metro wise, what are the consumer trends that you are reading at overall level?
So I would say the macroeconomic, factors are still a bit negative. Even if you look at the results that have come out in consumer durables and FMCG companies, it's not that promising. So I would say the growth that we are showing now is down to our own strengths and the changes that we have made. So even if you compare it with our peers, we have been much ahead. So I think that macroeconomic push is still pending, where the overall demand has seen an uptick. So I think when we see that, then the numbers will be even better, because overall rural and tier 3, I think it has been a bit of a slowdown in the last 18 months.
Interesting. And just to expand that point, are you also seeing that your metro or tier 1 store would have not done as well as your tier, let's say 2, 3, 4 stores?
No, in fact, we have almost, I think we have 5 stores in Delhi now, and 3 of those stores do better than national average. So even if you have a tier 1 store, the strategy around the location matters a lot. So even in Delhi, so we are located in a location called Maipalpur, Kapashera. So you have to be in a location where, there are a lot of migrant population, and there's a lot of low middle class customer. So like I said, the customers that we cater to is 80% of India. So even in tier 1, there are people who are servicing the upper class. So if we open a store there, then it does well.
Perfect. Second question, just to get some sense on the nature of expansion that we are planning. Are we focusing on deepening our presence in existing markets, or are we entering new states, new markets? And additionally, if you have to just give a ballpark, that what percentage of expansion will be in existing states or markets versus the new one?
So I think 80% of the expansion would be in existing clusters or states that we're already present in. But yes, we are testing new markets also, because, in the next 2-3 years, we want to be a national level retailer. But only 1 or 2 stores there to test the water, check the local trend, and strengthen our model in that particular state, and then we'll expand in that state. But I think around 80-85% will be in existing clusters and states that we are present in.
Got it. And the last one, if I may, usually what is the thumb rule that we should work with, let's say for 50 more stores? How much of DC area you will need to add, or will you need a separate altogether a new warehouse to fund to support this expansion?
So the figure is around like 15% you always need as a warehouse space of your total retail area. So if you are opening 50 more stores, that's 5 lakh square feet. So we would need about 75,000 to 1 lakh square feet extra for that.
Okay. So this will be brownfield, or you will kind of zero down on a new location?
So currently we are servicing everything for Farooq Nagar. So we have taken another DC that can support us for another, I think, 80-90 stores. So like the kind of expansion plans that we have, Maybe in the future we'll have regional DCs where we'll have a South DC, East DC, and a North DC.
Perfect. Perfect. That's all from my side, and Diwali wishes to you and the team. Thanks.
Thank you.
Thank you. A reminder to all the participants, if you wish to register for questions, please press star and 1 on your touchtone phone. The next question comes from Virendra Bajaj, an individual investor. Please go ahead.
My question is already answered by this concerned person.
Thank you. We'll move on to the next question. The next question comes from Rahul M., a retail investor. Please go ahead. Rahul, your line is unmuted. Please proceed with your question.
Hello, am I audible?
Yes, sir.
Yeah.
Please go ahead.
So congrats on a great set of numbers. I had a couple of questions. First is around V2 Smart Manufacturing, the subsidiary that you have. So I think in the last call, you had mentioned that there is a 10 to 15% cost advantage that you get, for the apparel which is manufactured in-house versus what you source. So I was wondering whether there is any plan to expand the capacity of that subsidiary, or if it doesn't make much business sense, whether you are going to have it off and free up some capital.
So plans to expand the manufacturing facility, and the whole idea behind it was to get the kind of efficiency where we can negotiate with our vendors better. So now we have transparent costs of making each and every garment, and it has really helped us in getting contract manufacturing also done. So now last year I think our own manufacturing constituted 20%. It's already down to 15%, and it will keep going down in the future. So we have been able to achieve the goal behind why we opened those, and now we've been getting that benefit of cost by showing the kind of efficiency that we show in our own factory and tying up with good manufacturers.
Got it. And another question is that although last 2 years have been amazing from an execution standpoint, but I think almost sky is the limit, right? You also mentioned earlier in the call that 1,000 plus stores can be reached without a sweat. So as you expand, are there any special initiatives that the company is taking to, let's say, expand the management capacity, or any people or HR practices to bring down the retail store attrition, or maybe run a loyalty program for the repeat customers and so on?
Yeah, so there's a lot of things always happening, and there's a lot of hiring also happening. There's a lot of retention things that have happened. Like I said, there are a lot of retention bonuses also. There's a lot of team building activities, and the kind of training and the career path that we have in our company, I think that is why it's one of the best in the industry, because we have a lot of examples where the salesperson sees that like our retail head was a salesperson and he started from the low level and now he's a retail head. So there are a lot of examples within the company that motivates others in a way that they see that they can have a similar career path, because there are a lot of internal appraisals that happen, and I think that's good for any company.
Okay. Thanks a lot, and have a great Diwali. All the best.
Thank you.
Thank you. The next question comes from Shreyans J. from Swan Investments. Please go ahead.
Hello, Akash. Great set of numbers. Congratulations on that. You mentioned that your cost per square foot is about $200 a month. Now, if I were to think about the total store area at the end of FY25, so my sense is we'll end at about 18 lakh square feet, right? And if I take 1,000 rupees square foot of sales, so we'll do about 1,800 odd crores. And like we're saying, we'll do gross margins of 25%. So I'm just trying to understand, when you're saying 120 crores of EBITDA for the year, the maths doesn't add up, because you do 200 rupees a square foot, so that's 2,400 cost, right? 2,400 per square foot into 12 probably, right? So into 18 lakh square feet. So that's about 430 crores of cost, and you're going to do an gross margins of about 450, 500 crores, So you actually end up with about 3 to 4% EBITDA margin. So I'm just trying to understand how are we getting 120 crores of EBITDA? Just if you can help me understand that.
Yeah, because the gross margin that you're taking is 25, whereas the actual gross margin is 28. That's where the error is.
But you also mentioned that, Q2 and Q4 is slightly weaker for you, so blended, you think you can end the year at 28%?
Yes.
Okay.
Because Q3 is good. Q3 is usually 30% gross margin.
Okay. So, and in this 200 rupees square foot a month, you don't see any, so this is after considering inflation and new store expenses and all of that?
Yeah, as we open stores, it should come down to 190 because we'll be leveraging, like I said, there's a lot of hiring that has already happened at the head office and the store level in order to service the new stores. So once we open these 50 stores, I think this number should come down to 190.
Okay. And this 190, what is your guidance for the next 2 to 3 years? Say, what kind of leverage do we have in this number?
I think it should remain at 190. So whatever leverage or whatever inflation we get will be set off with the leverage of additional area.
Okay. Okay. All right. Thank you. Thanks a lot and all the best.
Thank you.
Thank you. The next question comes from Nitesh Kumar, who's an individual investor. Please go ahead. Mr. Kumar, your line is unmuted. Please proceed with your question.
Yes. Am I audible to you?
Yes, sir,
you need to speak a little louder, sir.
Okay. Yeah. Thank you for giving me the opportunity, and congratulations to the management on the good set of numbers. And, my question is for the employment front, like employment generation. Could you give me an average number of person employed on a single store? Like
it's about 35 people per store, 10,000 square feet.
Okay, 10,000 square feet and 35 number of. And what is the approach of management, like increasing the employment of in a single store or like automation near future?
I don't understand your question, sorry.
Like the management approach for increasing the number of employees or decreasing near future?
So I think we have, been very efficient. We have focused on creating a process at the store level where we don't need a lot of salespeople at the floor to attend to the customer, because now each and every garment in our store is like hanging. So there's no stacking at the store where you need staff in order to set the garments back. So that is why we've been able to run such big stores with only 35 manpower, and I think it's essential manpower only now, which is cashiers and the guard and the housekeeping. So I don't think there's scope to reduce this further.
Okay, got it. Thank you. Thanks a lot, and all the best for the festive season.
Thank you.
Thank you. The next question comes from Simanto Saini, an individual investor. Please go ahead.
Yeah, hi. Thanks for providing the opportunity. So I just wanted to know that can you share the cost spent on advertisement for this quarter? Are we sharing that?
The cost of advertisement would be less than, I would say, 0.5%. But when I say marketing cost, so we give a lot of gifts to customers, whereas we have a lot of bill busters running at the store level, where we, for example, we were giving a bed sheet only for 99 rupees, and that bed sheet costs us almost 160, 170 rupees. So we tell the customer that if you buy for more than 1,500 or 2,000, then you can get a bed sheet at that price, where the market price of that bed sheet would be 300, 400. So instead of advertising costs, it's a lot of marketing costs in terms of kind and gifts to customers. So that would be about 1.5%.
Okay, and with the increase in the competition, so how are you seeing the marketing cost or the advertisement cost to, like, it would be the same in the coming quarters, or would it increase? and by how many basis points, if you can clarify that?
It should be the same. I think because, like I said, our markup is only 55%. We're already giving a lot of value to the customer, and we're passing on a lot of benefit to the customer, and the customer sees that. So our product is our brand ambassador, and that's the best marketing tool. The kind of variety and the assortment we sell and the price that we sell at. So our marketing cost will always be around 1.5%, including the gifts and the offers that we give at the stores.
Okay, and what is the average cost of opening a new store?
The capex required is 1,000 rupees per square feet. So for a 10,000 square feet store, it's 1 crore.
Okay, and what would be the average square feet size for a showroom?
Average what?
Square feet, like what would be the size of a showroom in average?
Average store size is 10,000 square feet.
Okay. Okay, yeah, thank you, and all the best.
Thank you.
Thank you. The next question comes from Abhishek from ABC Capital. Please go ahead.
Hello, am I audible?
Yes, sir.
Can you, what kind of PAT number are we targeting internally this year?
PAT? So we're targeting EBITDA pre-Ind AS EBITDA of 120 crores. So I think PAT is 55% of that. So it should be about 65 crores.
Okay. Thanks.
Yeah.
Abhishek, sir, you have any further questions?
No, thank you.
Thank you. The next question is from Paramjit Singh, an individual investor. Please go ahead.
Yep. Mr. Akash, I am a pretty old shareholder. I want to understand, if you open a store now, how long does it take to reach per square feet sales of 1,000 vis-a-vis the situation 2 years ago?
So 2 years back, our company average was 680, and new stores did 550 to 600 rupees per square feet per month. And now the company average is more than 1,000, and new stores, the base is around 900 rupees per square feet. And historically, we've seen it takes about 18 to 24 months for a store to mature. So when we see the cohort, we see that, the stores that we opened in the last 3 years are growing at a faster rate than the mature stores. So it takes about two years for them to come close to the old stores.
So you mean if you open a store now, it will take 2 years to give you per square feet sales of 1,000 rupees per month?
No, what I mean is, so going forward, like I said, so this year we will do more than 1,000, and going forward next 2 years, our target is 1,200 rupees per month per square feet sale. So the maturity period is 2 years. It depends on the company base. So when the company base becomes 1,200, then it will take 2 years for those new stores to do 1,200. But now, the stores that we opened 2 years back, they have reached 1,000 after 2 years. This year.
Okay, got it. And one more question from my side. I want to understand, do you have any plans for, let's say, fundraise, QIP? I mean, your competitor Zudio opens 200 stores every year, last fiscal year and maybe this fiscal year as well. So if you have everything set, processes defined, groundwork done over the last 4 years, why not accelerate more and open 200 stores in a year with some QIP, fundraise and all that? Are you thinking on those lines?
No, we're not thinking on those lines because, of course, like when you grow at that pace, it comes with an added bit of risk. And we feel, we have only implemented maybe 20-25% of the vision that we have for our assortment. This is just the beginning. So I think if we reach that magic number of 1,200 rupees per square feet per month and, ROE of 25%, then we might think on those lines. And currently we feel we're still undervalued. And so I think maybe in a couple of years this would change.
Okay. And one more thing, one of your competitors also got into beauty segment, right? I mean, Zudio Beauty and all they have opened. So in the longer term, do you see this value conscious market will also expand for you beyond apparels and maybe some more categories as well? How do you foresee future for V2 Retail?
See, we can't predict the future, but right now we don't have any plans to dilute our focus in any other category or even premiumization or any other brand. We want to focus on this, increase the footprint because there's immense potential just in this model. Maybe in the future when we feel okay, this is getting saturated and we have the bandwidth to expand into other categories or models, we would think about it. But right now there are no plans.
Okay, got it. Thank you, and Diwali greetings to you and the team.
Thank you.
Thank you. The next question is from Akash Singh, an individual investor. Please go ahead. Mr. Singh, your line is unmuted. Please proceed with your question. As there is no response from the line of current participant, we'll move on to our next question. Our next question is from Kushal Goenka, an individual investor. Please go ahead.
Hi, thank you so much for the opportunity. Sir, what kind of post-Ind AS EBITDA number that we are looking for FY25?
We don't look at, even the projections that we make, we don't do post-Ind AS because pre-Ind AS only makes sense to us. So even the investors and, internal targets, everything is pre-Ind AS. All the reports are pre-Ind AS. So we don't even make the numbers for post-Ind AS.
Okay, thank you. And second question would be, since Q2, do you think from next year, like FY26, Q2, we can see a positive PAT? Because since we are growing and if we get the operating leverage, so can we see a positive PAT from Q2 next year?
Yeah, definitely it can be. But the first target was to be EBITDA positive and for all 4 quarters, which we will achieve this year. But then the next target would be PAT positive in all the 4 quarters. So hopefully by next year we can do that as well.
Okay, that's great. Thank you so much and best of luck.
Thank you.
Thank you. The next question is from Manav, an individual investor. Please go ahead.
So can you give the store addition for the H2 or how much you're going to add in the H2 of this year?
So I think I already mentioned it. We would add around 40 stores in H2.
And so can you give the sales growth guidance and the same-store sales growth guidance for this year?
So first 6 months it was 34%, and I think for H2 our target is around 15 to 20%.
Hi. Okay, sir. Thank you.
Thank you.
Thank you. The next question comes from Bhagyavant Reddy, an individual investor. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yes, sir.
Yeah, sir. I just wanted to know the current ratio of stores that are profitable and that are burning. So how many stores are profitable and how many are in loss right now?
So we don't have a single store right now which is in loss. I think it's the first time in the company history.
Okay, that's great. And I had another question on our manufacturing. All our manufacturing is done in India or some part of it is overseas?
It's a very insignificant amount. Most of it is from India.
Okay. Yeah, thank you, sir. Happy Diwali.
Yeah, but we are exploring Bangladesh as a alternate.
Okay.
Thank you. The next question is from Vinayak Kariwal from Exponent Tribe. Please go ahead.
Hi, sir. Thank you for the opportunity. And so you mentioned that you were basically doing commodity in 18 and 19, and now you have focused on your brand identity. So I wanted to know what is the unique selling proposition. So if we imagine a Style Bazaar or various other value retailers compared to a V2 standing there, what will a customer why will a customer enter a V2 and not the other players? Will it be the unique uh, pricing or the product or the store experience? So what's the focus and USP there?
Yeah. So, historically, people used to follow brands or buy brands because they found something different or they found the latest trend or, whatever that celebrity is wearing or whatever the fashion influencers are wearing, they always found that product in that brand. And that's why they were willing to pay higher for that particular assortment. But now, like I said, because of fast fashion and because now, the cost of making the garment is not a lot, but the brand markup is almost 500 to 600%. So we want to bridge that gap where, our markup is only 155%. So the cost to MRP multiple there's a huge difference. So, we were just taking a feedback from our customers, and one of the customers said, okay, I bought a Levi's t-shirt for 2,200 rupees. And, I'm getting a better t-shirt in V2 for 300 rupees. So when people thought about brands earlier, they thought, okay, because it's at a higher price, it means it is a better product, which is not true. It is a higher price because it has a higher markup. So when you say why would a customer walk into V2? Because they will be able to find the latest fashion, the best fabrics, the best colors, the best fits, and they would get that product at a 55% markup. So that's the unique selling proposition, or that's the value proposition. But like I said, we've only been able to implement maybe 20-25% of the product assortment that we want to have. And the day we reach 100%, I think, like I said, the sky is the limit, and it'll be amazing. Whoever is able to do that actually in India.
Okay, sir. So you think if a store near you could do a lesser markup or provide a higher value proposition, maybe your competitive advantages would suffer?
So it's not just about the markup. Like I said, again, it's assortment as well. Anyone can sell at a lower price, but you cannot talk about assortment in words. If you actually visit a store versus our competitors, then you'll see the difference. And numbers say, and numbers talk. So everyone can say that their assortment is better than the other, but at the end of the day, it's the customer who decides. And like Zudio has n number of competitors from Aditya Birla has Style Up, there's Style Union. There are n number of competitors, but if you walk into Zudio, it will always have 5 times the customer than any other closest competitor. So until unless you visit the store and see the product, it's very hard to put into words that what the customer is getting different, because it's not like they have different margin strategies or Zudio is selling at a much lower price than its competitors. But it's the assortment, the kind of, like I said, 4 attributes of a product. You have to get all 4 correct, and you have to do that for 3,200 designs. So at any given point of time at any of our stores, there are 3,200 designs and 3,200 SKUs. So it's all about assortment.
Okay, thank you.
Thank you. Ladies and gentlemen, we would take that as our last question for today. I would now like to hand the conference over to Mr. Akash Agarwal for closing comments.
Thank you everyone for joining on the call. We hope we've been able to answer your queries. For any further information, we request you to get in touch with Marathon Capital, our investor relations advisor. Wish you all a very happy Deepavali and New Year. Thank you.
Thank you. On behalf of V2 Retail Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your lines.